Real estate is obviously one of the best, if not the best, long-term hedge or capital appreciation ploys you can allocate your capital to, which is why we all broke into it. However, the cash-on-cash returns or cash flows on a monthly basis, especially if you're partnering with a syndicator or a hedge fund or a high-octane material or partner, the monthly distributions can be negligible, especially in a time like this when everything is negatively leveraged. So I'm talking maybe anywhere between 3 to 7%, depending on how aggressive the operator is.
Welcome to The Foundry, where leaders are forged daily. Each week, we investigate themes of leadership, entrepreneurship, and mindset with some of the greatest minds in real estate. And now, the data scientist of real estate, George Roberts.
All right, welcome back, entrepreneurs. Today, I have the pleasure of interviewing Benjamin Cohen, a partner at SE Portfolios, where he focuses on capital raising and acquisitions. Welcome to the show, Ben.
Thanks for having me.
All right, Benjamin. So I want to say this is a little bit of a different approach. Usually we talk to real estate entrepreneurs, but today I know a lot of my listeners are very interested in alternative assets. Of course, real estate syndications are an alternative asset. And I think this will be a real treat because I don't think most people have thought about purchasing a mature drop shipping company. And we're going to have the opportunity to explore what that might look like. So we're going to learn about the asset class. What is drop shipping? What is it like to purchase a mature company, and how you can get a piece of the action?
Well, I appreciate the intro, George. I'll give a quick background about myself so people know who I am. I come from the real estate private equity space, so I speak everyone's language. I ran the acquisitions and capital markets department for 𝐿𝐿 Capital, private equity firm that syndicates capital to buy multifamily institutional assets around the Southeast, kind of like most of us. So I ran the acquisition, underwriting analysis, preliminary sub-market analysis, and I also raised debt capital. So that was fun. Did that for about 2.5 years, and I parted ways with commercial real estate because I was a little bit more attracted to the cash-on-cash returns in different vehicles. And I stumbled upon this unique offer a couple of years ago. I've been working on the side on this project with my partners for a while now. Blew up, and now here I am. So I met George a couple of weeks ago. He's been phenomenal. So I'm super excited to be here and share the whole story with you guys. But quick back of the napkin, very simple version of what we do is we build from scratch, or we buy an existing online business. So if we're building from scratch, we'll put anywhere between 40 to 50,000 into it. Once the business is generating.
Well, let me stop you there, Benjamin, because I want to talk about drop shipping. For those, I think most people are probably familiar, but I'm sure there's a lot of people out there. So what exactly is a drop shipping business? How is that different from you doing it yourself, getting your own warehouse and doing it from soup to nuts?
Excellent. So drop shipping, from a consumer's perspective, whenever you see an ad, you order it, you pay for it, and the supplier ships it to your house. So as the business owner, it's a very low barrier to entry. You see a lot of 18, 20-year-olds trying it because maybe you can start a website for a couple $100 here and there. Within $5,000, you're up and running. But it actually is very capital intensive if you want to do it correctly. Drop shipping is only one of the services that our company provides as a vehicle to purchase. But drop shipping is the most saturated in the United States. And thankfully, we actually do not operate in the United States. We operate mainly in Europe and Mexico. And but yeah, if that answers the question from a consumer's perspective, very simple. You order a product, you pay for it online, and it's shipped to your house, kind of like Amazon delivery.
Awesome. So then I guess the follow-up question for me is, hey, I'm in real estate. What's so great about drop shipping? Well, why do I want to purchase a business as opposed to just going out and purchasing another apartment or maybe a hotel?
Excellent. So I could talk about real estate returns and sensitivity analysis all day. I'll try to keep it as short as possible, but real estate is obviously one of the best, if not the best, long-term hedge or capital appreciation ploys you can allocate your capital to, which is why we all broke into it. However, the cash-on-cash returns or cash flows on a monthly basis, especially if you're partnering with a syndicator or a hedge fund or a high-octane material or partner, the monthly distributions can be negligible, especially in a time like this when everything is negatively leveraged. So I'm talking maybe anywhere between 3 to 7%, depending on how aggressive the operator is. Assuming you're an LP and you invested $100,000 in a multifamily deal in Texas, for example, assuming you make 5% a year in cash-on-cash returns, you're making $5,000 a year. If you divide that by 12, you guys can do the math, close to like $300 to $400 a month. pretty
Right.
negligible. So I decided, okay, I'm 24. I broke into private equity when I was 21. So I was like, what can I do to be a vector? What vehicle can I find as a vector to then invest my personal capital into real estate? So in the short term, I found this. So the short term, I mean the next 2 to 6 years, to grow capital substantially, significantly much quicker, and then invest long term. That's my personal ploy. But for an investor, I would say, depending on what your goals are, if you're looking for capital preservation and long term appreciation, obviously real estate is definitely a ploy. In this case, if you're looking for capital preservation, risk mitigation, and hefty liquid cash flows on a monthly basis, this has been the craziest thing I've ever seen, and it's the funnest thing I've ever seen as well. It's great. Most fun. Sorry, excuse me.
Right, absolutely. Well, hey, I like words like funnest because I think that's, really we got to just enjoy this entrepreneurial journey. So, okay, so again, to separate it out from real estate, sure, real estate tends to be pretty safe if you buy right, if you have the proper debt on the property. I mean, look, you are doing pretty good, but again, yes, it can be hard. A lot of these syndications, you might not get something for the first year, depending on how stabilized the property is. Are you buying Class A, Class B, Class C? Maybe not the first year. So you're not really starting things up from the beginning. Like if I say, hey, Benjamin, I want to come in, I want to buy one of these drop shipping businesses, and maybe I'm selling exercise equipment in Catalonia or whatever. But it's not like we're just starting this thing up from scratch. What sort of things do you do? What have you done by the time you get ready to actually offer one of these businesses?
Awesome. Well, I'm glad you interrupted me earlier because this is much more organized. But to give you a quick back of the napkin of what we do, we either buy an existing brand that's been stabilized, that's been operating for, let's say, minimum 6 months, that's been generating anywhere between $20,000 to $30,000 a month net in profit, which is significantly more expensive. But what we also do is we build a business from scratch. We do. So we put about 40,000 our own money into the business to get it off the ground. Once the business is generating anywhere between $2,000 and $3,000 a day in gross revenue, top line revenue, if you want to analogize it to real estate, GPR, once it's generating that on a daily basis for about 25, 30 days in a row, and the product that's being sold on your online store is yielding a minimum 8.2x return of ad spend, meaning if you put $1 into ads, you're going to receive $8.2 back in projected revenue per dollar we spend in ads. That's our entry basis minimum threshold to break into the business. Once all of this is stabilized, then we sell it to you. So we de-risk everything. We put all the money in up front to get it off the ground. We're stabilizing it for you. Then you purchase it for about, depending on the end price that's negotiable, but usually 120,000 plus 40,000 in working capital or operational reserves. And then we operate everything for you, everything.
Right. That's important too, because a lot of people are probably wondering, hey, why do I want to go out and master a great new business? I mean, it sounds great, doesn't it? But hey, I'm in real estate or whatever you might be in, whatever your wheelhouse is, the whole idea behind passive investing in these alternative assets is that, hey, I don't have to go out and become an expert. Now I should be able to do due diligence on you and your team. I should do due diligence on drop shipping. I should probably know something about what we're selling. But it's not like if I buy one of these businesses that I have to go out there and say, whoa, what are we going to sell today? And what if this product stops selling? So you've got a lot of tools for that. You've got a lot of technology. Why don't you walk us through, how does that work? The products don't sell forever. So what do you do to know what to sell next?
Awesome. So we are vertically integrated. We have about 7 different, is it 7? I believe it's 7 different departments. So we have a media buying and advertising, an advertising agency that does media buying and marketing. We have an operations team that does product selection, product research, and product development. We have a internal and an external supply chain management team that handles our supply chain relationships, because they are the ones that make everything tick. We have a customer service department, that handles consumer inquiries. And then we also have a software development, website design, and website development department that handles all the convertibility and the optimization of the website. So obviously there's a lot of skills that one has to have. That's why it is a very saturated business. You see a lot of 20-year-olds trying it, but it actually is very difficult to do this correctly, especially in the United States. Clarify, most of our businesses are actually cash on delivery businesses. So we do drop shipping. The difference between cash on delivery and drop shipping, just to put this out there really quickly before I go into the nitty gritty, the difference between drop shipping and cash on delivery is very simple. think about it as a pizza delivery service. So I gave you guys an example of drop shipping, right? You see an ad online,
Right.
you pay for the product shipped to your house. Cash on delivery is when you see that very same ad, you can order it, but you don't have to pay for it until it physically arrives to your house. So you're paying upon in-person cash or card in person.
Right.
So the convertibility, the conversion rates, the click-through rates, every marketing metric you can think of has exploded, which is why our minimum threshold is 8.2 to enter into the business and sell a product, which has been fantastic for us. And we've also diluted returns by 40% because the consumer can, they can physically feel and see the product in person before purchasing it. So that is actually the preferred form of commerce in most European countries. We operate in Italy, Malta, Spain, Portugal, Romania, Finland, Luxembourg, and Mexico. Excuse me. Mexico is a really big one for us.
What about Norway? Are you going to break into Norway?
Norway, yes. Sorry, I remember that.
All right. Okay, we had a chat ahead of time. I'm not actually a psychic, but that's exciting because to talk about the psychology of this,
Correct.
I've been told, and a lot of these statistics, as people say, are made up on the spot, but I want to say it's something like 15%. That's the premium that people pay when they're paying with a credit card. But this is taking it one step further. It's not just like, hey, I don't have to pay cash. I can put on my credit card. I'm ordering this today, and I don't have to pay for it until it arrives at my door.
Exactly. And that we've seen, I have yet to see anything that generates more revenue, a gross revenue on a monthly basis and something like this, because we've removed a huge pain point, right? You don't have to pull out your credit card to pay for something once you see it. You can physically see it, smell it, taste it, whatever the heck it is. We don't sell consumables, so it's forget taste, but if you wanted to taste your sweater, that would be a little weird if we're selling sweaters, but essentially you can do all of that and then you can pay for it upfront in person. We always underwrite assuming 90% of the orders that are being placed are going to be collected. Assuming kind of like economic vacancy when you're underwriting a multifamily deal, assume 10% of the people are not going to want it, they're going to return it. But since they are like sweaters, apparel, fashion, consumer electronics, or pet supplies, we can ship it back to or we send it back to our inventory, and then we can resell it the next day. So it's been great. So yes, and that essentially is a very quick, simplified version of where we operate, and how we've got to scale. We have 98 of these that we manage with 74 different clients that we manage as well, and we're looking to grow as quickly as possible. It's great.
That's cool. So the first thing to notice is that obviously you've got repeat customers, and this is huge, right? You're putting $120,000 up front, and then you may be putting up as just as much into the working capital of the business. So this is, a huge investment. You've got people that have already been interested in going, at least 2, maybe, who knows, 3 or more times. Let me ask you about the mechanics of it. So when it's delivered, do you have to sign for it and then you give your credit card immediately? How does it actually work?
With our partnership with our manufacturers and suppliers, the reason why we're in those countries is because that's where our suppliers are based out of. So we're not susceptible to China. So that's fantastic. But our suppliers are the one physically bring it to their house. So upon arrival, the supplier will actually say, hey, do you have cash? If not, okay, we have kind of those credit card machines that you can insert your card.
Yeah.
Kind of simple as anything simple along that. At the end of the day, from a client's perspective, most of our clients really don't care what we're selling. They're just looking for high convenience, high yield, and excess returns per unit of risk. But yes, if you're asking about the consumer's perspective, there's a lot of psychology that goes into it, and it's either cash or card, like I just mentioned.
Well, it sounds like a great trade-off. So for a slight negative cash cycle, you're getting a huge increase in top line.
Correct. So we buy micro quantities of. Before I go into that, let's assume my book right here, Fundraising by Ryan Breslow. Great book. I don't know if it's a quick read. As you guys can tell, it's very small. Let's say this product here has a 40x return of ad spend, something ridiculous, right? Meaning if you put $1 in, you're going to get $40 per dollar you spend in marketing. Even though that product has a phenomenal return of ad spend, since we are selling the business to you, which is the difference between investing into a real estate syndication and owning an e-commerce business, you are the operator. I mean, we are the operator, excuse me, you are the owner. So we have to come to you as a partnership and say, hey, even though we are mitigating your risk as much as possible, since we do buy micro quantities of products, so only 200 to 300 units of product every 7 days, to avoid the risk of excess inventory, we can come to you and say, hey, this product has a 40x ROAS. We've been testing this for the last 4 to 6 days. Our advertising agency has identified this niche, this demographic, in this geographical region. We believe it's going to blow up. Can we buy more than 200 to 300 units of product? Which is why we have to have working capital. And then if we need more working capital, it's up to the client if they want to, because we get capped out, right? Because we're buying 200 to 300 units every 7 days. And so after that 300 units, we have to ask them, hey, can we buy more? It's your business. You're the final say. We're just a manager. We're just a property manager, essentially.
Exactly. And so there are some decisions that you have to make as the owner, but essentially you're taking care of everything, and
Everything.
makes a lot of sense. I mean, hey, you want to expand working capital.
Exactly. Yep, exactly.
All right. Well, how would a typical investment look like? So you said 120,000. So that's on the intake. You
Correct.
have to have a certain amount of working capital. Hey, it's up to you. But if you don't supply an appropriate amount of capital, obviously you're not going to be able to get a lot of products into people's hands quickly enough to keep the thing turning. So what does it look like? I mean, how long does it take, for example, to get your initial investment back on average?
So to answer that last question very quickly, your average return of the equity or your capital recovery takes anywhere between, on average, 8 to 14 months. So if you want to be very technical and very conservative, the max is 16 months, but the average is 8 to 14. So that's the return of equity or capital recovery, or you're receiving your initial investment back. Now, what was the first question you asked?
Well, just want to kind of go through it. So from end to end. So my first question is, hey, what does it cost to get in? And then my second question would be, how long does it take me to get my capital back?
Absolutely.
And then from there, what does the business look like? What am I going to start netting once I have a return of capital?
Excellent. Okay. So the initial investment, this is not an investment. You're just buying a business. So the initial capital contribution is to buy the digital franchise from us. It's like you're buying a Chick-fil-A. From our imaginary inventory right here is 120,000. Okay. Yeah. We do need an additional minimum $40,000 in working capital. So 30 goes into your working capital or operational reserves. So we bought the Chick-fil-A. Now we have 30K that goes into this bucket to buy the chicken and the buns and the tomato. Right. And then we put 10K into our agency ad account so we can do marketing for the business. That 40K in total is revolving, and it pays itself off every 14 days. Because like I said, right, we buy product every 7 days, but the revenue takes 14 days to hit your Wise account. So it's perpetually, from an account balance perspective, if we didn't have working capital, your P&L is always going to show negative, even though you're making money in your cash flow, because of the lag, right? There's a perpetual lag, because revenue takes 14 days and we're buying product every 7 days. Revenue takes 14 days to hit your account, excuse me. So now the way the structure works, I'll give you guys a very simple version of what it looks like, as conservative as possible. On average, just scaling one product, let's say we generate $60,000 a month in gross revenue, something super simple. Assuming we're going to collect 90% of that, as assuming for economic vacancy, that's about 50K. If we multiply 54 by 0.3, what is that? 54,000 times 0.3, that is 16,000. Now, why did I do that? After all operational expenses, we are usually left with about 30% margins on average. So that is our NOI, our monthly NOI. In this case, if we multiply 54,000 times 0.3, 30%, that is $16,200 in net NOI. Now, since there's no debt service here, which is fantastic, if you're comparing this to a levered capital stack, since you own the business, you are the senior loan and all the equity, pref, common, all the classes of equity you want to call it, along with being the owner. We're just the operator. So you have to get paid first. It's in writing within our management contract. So we allocate the first $5,000 a month off the top. So in this case, we're left with $16,200. $5,000 off of that goes back to you. We do not get paid until after the first 5K. It serves as pref equity.
Right.
So if we subtract 5,000 from 16,200, we're left with 11,200. So you've made 5,000 back. Now we're going to divide 11,200 divided by 2. You would have made passively in your pocket $5,600 plus 5K. So you would have made a total of $10,600 in a very average conservative month of just generating $60,000 in sales. Now that's scaling only one product. Now, if we had $60,000 or $70,000 in working capital, we can scale 2 or 3 products and we can generate on average $150K a month, but the math is the same. So it's very similar to just a common, waterfall structure when it comes to distributions, but it's more like a 70-30, 70-20, 75-25 split until we pay off your initial investment. And then it's a true 50-50 of the NOI, if that makes sense.
Yeah, that's great. So then why don't you translate that into like IRR? What are we talking about? Or even just maybe your average annual return. Okay. So you put in, at this point, you put in $160,000 and you're making about $11,000 a month. And there's multiple examples. So the first example, you're making about $11,000 a month. Yeah, I mean, wow, that's showing just how possible it is to get
Correct.
your capital returned within, say, roughly a year.
Correct. So yes, 160 is all in. A lot of our clients
Right.
do leverage credit. So they either use a line of credit or a credit card, which is the beauty of e-commerce because you can credit stack. So you can either come through us, we have a credit partner or a credit broker who can leverage 0% APR credit cards. Or you can use your own personal or business credit and we can use that as working capital. So your initial contribution is only 120. So your annualized returns, if you're comparing it to your initial investment, can be paid off even faster if you leverage credit. Now, your annualized ROI or your annualized return on investment. It sounds crazy, but in year one, it's close to 132% from what, based off of my calculations, what we've done internally and with our underwriting department. But to be even more conservative, our annualized returns or average annualized returns is close to like 72 to 83%. Depends on the business. E-commerce is a very cyclical business. So September through January 1st is the most aggressive because Cyber Monday, Black Friday, Thanksgiving. Well, we're not operating in the US. So Hanukkah, Christmas, January 1st, that's when it blows up. You generate usually anywhere close to $20,000 to $25,000 a month profit in your pocket as the passive owner. And then January and February, it's a little bit slower. The consumer's exasperated. They're burnt out. March through August, it's a more stable, closer to that 60 to 80K. So you're talking about 11, let's just say 10K a month. So your IRR, it's very hard to calculate this because it's such a cyclical business and it depends on when you want to exit. We do manage this for you for 3 years minimum. If you want to re-sign with us, there's no extra add-on fees. There's no extra management fees. We don't charge any fees. It's just a performance-based fee after we pay off that first 5K after you. So you have to get paid first. So if you exit in year 3, assuming we generated $1 million in revenue a year at 30% margins, that's 300K. Assuming no growth for 3 years, that's 900K in NOI for year 3. You can sell the business for about a 3x terminal exit multiple, and you can sell the business for about 2.7 if you wanted to. So your equity multiple is ridiculous. It's very hard for people to believe. Your IRR is through the roof. So I tend to not underwrite it because people wouldn't believe me, so I have to show them. Same with George. I actually, before this call, I had to show George so he can see with his own eyes. But yeah, in numbers, your equity multiple is ridiculous.
Yeah, actually, that's showing. I'm glad you mentioned that because it might be kind of cool to see your technology. Maybe we'll do a screen share later if you're up for it. It's pretty cool because, again, I think seeing the numbers is believing and just understanding that, hey, you guys are not flying by the seat of your pants. You've got a lot of technology out there that's telling you what's selling. You're always trying new products. And then if something stops selling, slows down, then you're looking for something else to move into its place. Well, love that you covered the exit and then you just sell it for the person at that point, right? You just say like, we're going to handle that for you, correct?
So we would like to do that. We're building out a debt fund right now. We're also building out a buyback program because right now, no, you would have to go to a third-party broker, which you pay the same brokerage fee. But you can sell it with management or without management. With management, it's going to be much more valuable because you're selling it with a professional management team. If not, it's just the multiples are still ridiculous. But you would maybe pay a 5 or 6% maybe brokerage fee / soft costs here and there. But you're still exiting at I don't know, let's just say 1.8 million. Assuming that your initial capital investment was 120, it's still a ridiculous exit. But you don't have to exit. You can re-sign with us for no extra fee and we can continue to cash flow and build you the brand. Because essentially we're building the IP, the intellectual property. We're building a social media following on all social media platforms. And we're also building an email list and an SMS list. That is very valuable along with a branded product. You could exit in 5 to 10 years as we have a branded, I guess, more of a branded business. You can exit at a much higher multiple. And what we do is we build portfolios. So we want our clients to be diversified and dilute their concentration risk and get to economies of scale. That's why we have suppliers in all those countries I mentioned, because let's say absolute worst case scenario, let's talk risk a little bit. Let's say Norway, you own a business in Norway that sells coats to skiers in Norway. Let's say Norway has an internet outage for 20 days and the country blows up. Well, absolute worst case scenario, you have 7 other businesses in your portfolio that sells pet supplies in Germany, bathing suits in Italy, beauty supplies in Spain. You're diversified, right? You're at economies of scale. It's the reason why we all got into real estate. And ideally, the beauty of it, let's say Norway does blow up. Obviously, you don't want your business to be blown up with it, but it's digital. So we can physically pick up the business and move it to another country and relaunch everything and be up to par and at speed within 7 to 14 days. which is the beauty of e-commerce. You can pivot off of a dime, which you can't get in traditional vehicles like equities, treasuries, real estate, et cetera.
Okay, great. And then there's the alignment of interest. So I shouldn't just expect that you guys are going to get out there and be lackadaisical about it, because I think you said it's 75-25 split up to the return of capital, 50-50 thereafter. So if you could 10x this business, that would be very much in your interests.
Exactly. We are tied by the hip. And let's say absolute worst case scenario, we generate 4,000. I've never seen this before in my last 3.5 years, but let's say we generate $4,000 a month net NOI every month for 6 months in a row. We don't get paid at all for those 6 months.
Right.
That $4,000 goes straight to you every month.
Yes.
So we get paid above 5K. So we're duly incentivized to perform so we can make money as well.
Exactly. And so per contract, it would have to be 2 years would be the worst for you to get your return of capital if you put $120,000, if that was your entry price.
Exactly. So it's very hard to lose money if your goal is capital preservation. It's very hard to lose money in this business if you have the systems and scale that we have and the global supply chain network. Because let's say we're targeting 19-year-old girls in Southern Italy that like bathing suits. Okay, our entry return of ad spend has to be a minimum 8.2x return of ad spend. Once the product actually fizzles out in demand, because products do die out in demand, and it dips below 5x, which is still good and actually great relative to dropshipping businesses, but we still want to have a hefty spread so we can actually hit the returns that we're projecting for our clients. But if it dips below 5, we'll test the ad campaign, test the ad copy, the ad creative, even test a different demographic to actually validate the demand of the product. If it's not a marketing issue and the product just died, nobody wants it anymore, we are testing products in the back end, and within 36 hours, we can actually launch a new product that has a minimum 8.2x return of ad spend. So we're constantly pivoting, we're constantly moving, and from a month-over-month basis, you never really see a drop in revenue that much in a scenario like that, if that were to happen. So that's the beauty of this, which is why you can, pivot and preserve capital much easier than in other vehicles.
Yeah, that's awesome. But I want to come back to how you're picking the products. Thank you for tuning in. If you want to learn how syndicators can get a piece of the action with SE portfolios, tune in to the second half of this exciting interview, where we cover how you as a syndicator can get a piece of the action, the technology behind building these companies, and so much more. Catch you on the flip side.